Hello friends, this is Vijay Bhambwani, and in this video I want to discuss what to expect from the market going forward. Last week was a very unique week, and how? I warned my online family via a Telegram and WhatsApp update that you should expect the market volatility to spike through the roof. Of course, this was reiterated in my live mint column because 60% of the world's economies were going to be impacted by interest rate decisions by their central bankers, starting from the United States Federal Reserve on Wednesday night, which would impact trading on Thursday morning in India, and then followed up by Bank of England, the European Central Bank, the Swiss National Bank, and the Russian bank itself. Of course, the Russian interest rate decision was not going to impact the markets as much. But the European, the British, and the Federal Reserve, most of all, was the game changer. And we saw volatility spike through the roof on Thursday, and wow, what volatility. Once the 21,150 Fibonacci level, which I had advocated in my last week's video, was overcome, the market did not look back at all. The entire market, where volatility and rise above 21,150 on the Nifty is concerned, it was all as per expectations. Now, what do we see going forward? First of all, what we do need to see is how traded volumes shape up in the week ahead. Friends, I've recorded a special video some time ago on traded volumes, their implications in a rising and in a falling market, and what they actually signify. The hyperlink to this video is in the description below this video, as well as in the pinned comment below. So do make it a point to watch that video carefully and understand how you should interpret volumes in the coming week. Now let's dive into our usual standard operating procedure, and let's take a look at the weekly market roundup. The rally was led by the broader based Nifty 50, which gained more than the Bank Nifty. The US dollar index, the Dixie, continued its downward fall, which was exacerbated by the US Federal Reserve, which not only did not raise the interest rates, but also gave a kind of forward guidance which seemed to imbibe a sort of hope in the market that interest rates would soften going forward. Do remember, 2024 is an election year in the United States, and political compulsions may just force the Fed's hands. The USD INR, which is the United States dollar versus the rupee, also fell 42 basis points, which means the dollar basically weakened against the rupee. That was another bullish factor for India because imported inflation would be contained. Now, a weak dollar triggered buying in bullion, in silver more than in gold. And we also saw some amount of relief rally come in crude oil. My online family will remember how last week I had posted an update both on social media, on Twitter, Facebook, etc., and especially on my free Telegram channel, where I said I actually want a pullback rally in crude and natural gas because I don't really have any short positions in these counters, and I would love to kind of get my teeth into the flesh all over again. So, yeah, natural gas did fall because warm weather and lack of demand in Europe kind of pressurized the prices. But crude oil did attempt to go up, also aided by the cuts announced by Saudi Arabia. The Indian 10-year benchmark bond yields fell 6 basis points, which means bond prices rose after the US Federal Reserve and, of course, the Bank of England, ECB, and Swiss National Bank failing to raise interest rates. So that was another kind of a relief for banking stocks. The NSE gained a little under 2.5% in market capitalization, which tells me that the rally was fairly broad based. The market wide position limits, MWPL, rose routinely after expiry, and the US indices rose uniformly, thereby providing tailwinds to our domestic markets. Friends, now let's take a look at our in-house indicators. I start with the market-wide position limits. Now, these are exposure limits utilized by traders as compared to the total component allowed by SEBI. Now, this chart is a 20 weeks or in tenure, and it spans four full derivative cycles. And the prior one is, of course, the upthrust, but not the absolute bottom. So we are seeing the August peak, but we've not seen the post July bottom in this chart. However, what you can see from this 4.5 derivative cycle chart is that at 39.38% MWPL, we have seen the highest buildup of market-wide position limits since the expiry of July derivative series. Last week in my video, I told you if at all the round number of 40% is exceeded in MWPL, that would mean that bulls are writing out bigger checks and displaying signs of extremely high risk appetite, which could be enough to pull the markets higher. So at 39.38, we are a whiskers different distance away from that magic number of 40%. Will it happen? I think it could happen. A very good probability that this MWPL will cross 40% and possibly even hold above it. So markets have the steam to go ahead. Friends, I now look at the turnover of the stock futures and index futures. Do remember, these are cumulative 3-month expiries. So this is December, January, and February. The turnover has fallen. I'm a little disappointed, to be very honest, because the turnover in such a bullish kind of a week should have been extremely buoyant and significantly higher from where it is. That tells me that the retail has not really participated in the rally as much as the smart money has. To be very honest, Monday to Wednesday, the retail guy was sitting on the fence waiting to see if the US Federal Reserve would hike rates or not. By the time the retail guys could kind of react, the bus was already off the station, and many of them seem to have missed the rally, which explains why the volumes are lower. Do remember, I told you about that special video on interpreting volumes. Do watch that video, and the link is in the description and pinned comment below. Friends, I now come to the advanced decline ratio, which after the price itself is a fast leading indicator of which way the winds are blowing. Last week, the NSE gained 2.32% where price movement is concerned, but the advanced decline ratio fell marginally to 1.11 as compared to 1.14 in the prior week. That tells me that risk appetite was very slightly lower as compared to the prior week. No surprises there, because Monday to Wednesday the buying was fairly mild. It was only Thursday and Friday where buying actually picked up. Ideally speaking, I would want the price and the advanced decline ratio to move up together. So let's watch this data keenly. I update this data every day on my social media accounts, especially on my free Telegram channel. Do connect with me. My contact coordinates come at the fag end of this video. Friends, I now come to the basis. Now, the basis is nothing but the discount or premium prevalent in the futures as compared to spot. Do remember what I had told you about the basis. I told you last week itself that basis of this lofty levels was unlikely to sustain, and I would see a cool off. Sure enough, you're seeing the bank Nifty basis has come down by 50% in a fortnight. Last week itself, it's come down by approximately 40%. The Nifty basis by comparison has come down, relatively speaking, a lot less as compared to the bank Nifty basis compression. That tells me at higher levels, there was a bit of bull unwinding, maybe even a very small amount of short selling, and that's along routine lines. Also remember, as we get closer to expiry, the basis, just like options premium, the futures basis also tends to erode. As long as the basis is positive, which means the futures are at a premium, howsoever small, as long as the basis is positive, the bulls are still in control. As I now come to the impetus chart. Now, this is an in-house exclusive indicator you will not get anywhere in the public domain. Remember what I told you last week, and I also backed it up in my live mint column, that the impetus reading what we had seen last week, where the Bank Nifty was concerned, the impetus was within a kissing distance of 1,500. Since the time I have programmed this in-house indicator, I have never ever seen the impetus jump that high. And for the Nifty 50, the impetus almost went to 500 levels. Now, this was way above what it had risen to in the past 2 years or so since I have been using this indicator. That told me that there was ecstasy, euphoria, blind buying, pent-up buying, and a whole lot of frenzy in the market that required to be cooled off a little bit. In spite of the fact that the markets made new all-time highs, and the Nifty and the Bank Nifty, at least on Thursday and Friday, made huge advances, the impetus has come down, which means that there was a marginal amount of cool-off in sentiments. That's not to say that this can lead to an extreme fall. I'm not saying that. All I'm saying is that the rate of climb may just flatten out a bit. The angle, the rate at which the market is rising may just slow down a little bit. Here again, the impetus is something that I update on my social media accounts every night. Friends, I now come to the LWTD indicator, which you've trusted so much for over 2 years now. And this is again another exclusive in-house indicator you won't get anywhere on the internet. What you are seeing is the LWTD has risen a bit on a week-on-week basis, but still remains in the negative. That tells you that the market may be rising, but it is more because of short covering taking place at higher levels rather than a huge surge in buying. Now, how can MWPL go up? And I'm talking about short covering. Allow me to explain. If at all you are a STBT trader, which means short today, buy tomorrow, the market opens up with a gap, you cover the short, you trigger another run up in the price. Now, since you're a short-oriented trader, people do tend to form habits. There are diehard bulls and diehard bears. Now, you will again short towards the end of the session because the market has been rising throughout the day, and you want to do an STBT trade again. So you short near the close today, and you will try and cover it up at lower levels tomorrow, provided the market goes down. But if it doesn't, hey, you're covering your shorts in a frenzy again, triggering another upthrust. So the MWPL is continued to rise, reports a continuous rise, but you are seeing intraday short covering, which is triggering price rises. So what I'm saying basically is that the rally will be more due to short covering based pullback rallies than complete outright fresh buying. Do remember that short covering cushions declines, whereas it is actual fresh buying which is needed in large numbers to propel markets to a new high. So does it mean markets can fall? I'm not saying necessarily so. It might just slow down a bit. It might also fall a little bit because a routine correction after such a big run up is not something that you should be frightened of. Friends, our in-house indicators done. I now come to the aspect of the market which is very close to my heart, the bond market. Do remember the cost of money, the cost of funds is what makes the financial markets go round. This aspect basically determines how much price escalation in various assets will be seen because of buying support. You need money to buy anything, and if money becomes a lot more expensive, which means interest rates are going to go up, people tend to be a lot more cautious. And last week, four major central banks in the world, that is the United States Federal Reserve, Bank of England, European Central Bank, and the Swiss National Bank said, hey, we are not hiking rates. We might even cut rates next year because we have US elections. So 60% of the global economy is run on the basis of interest rate decisions of these four banks, and 60% of the economy seems to believe that they will get cheaper funds next year. Which is why bond prices went up and bond yields came down. Now that bond yields have started coming down and we are now at 7.16%, I had told you that at 7.10 or even lower and below definitely 7.00, I would go out and start kind of deploying money into gilt funds. Thursday morning, those of my online family have paid attention to the WhatsApp alert about a special post I put up on our free Telegram channel. I recommended four best picks amongst the gilt funds, and I told you to invest in these because on Thursday it was very apparent that interest rates weren't going to rise for a temporary period. They have peaked. And due to political compulsions, especially elections in the United States of America, the Fed might just even reduce interest rates going forward. So I recommended four gilt funds, and like I've updated on my Telegram channel, all four gilt funds have seen a smart rise in NAV in the 1.5 trading session itself. Because I recommended buying gilt funds at approximately 11 a.m., I'm counting it as 1.5 session. But on both days, Thursdays and Fridays, the NAVs went up because smart money started exiting regular bonds and went into gilts. Now that you've entered gilts, what is the way forward? Are we getting married to gilt funds? No. Hey, no, we are not getting married to gilt funds. Then what do we do? Supposing interest rates are constant or maybe even more dovish guidance comes in about interest rates being reduced, what you will see is the yield coming down on the benchmark 10-year Indian benchmark bond yields. Now, if it goes below 7.10 or maybe even 7.00, not unthinkable, can happen. What you will see is a smart rise in the NAV of these four gilt funds, maybe one, maybe two, or whatever. If all four gilt funds is something where you've deployed equal amounts of money, good for you. You will see varying degrees of NAV hikes. I will, in that case, post another update, but purely on my Telegram channel only. I will update telling you that it is now time to get out of these gilt funds and get back into 10-year sovereign bonds again, because you would have received a solid capital appreciation. Add back to the sovereign yields at say 7.10 or 7.00. If you've received 3 or 4% in capital appreciation and then you revert back to the Indian 10-year sovereign benchmark yield at 7%, hey, 10+% in a year coming in with a sovereign guarantee is something I would very gladly give my right arm and a right leg for. So, like I told you, even if interest rates have peaked out, I will show you a very high probability rate, a very high probability trade wherein we can still make above average returns. I am not done yet. I still have a few aces up my sleeve. My statistical trading model IBEX and my behavioral trading model the Barracuda have some more strategies ahead in the markets which can capitalize on the interest rate move. So stick with me, and like I said, follow my Telegram channel. That's where 100% of our research is present. Friends, the bond market's done. I now come to the Bank Nifty, which gained 1.87%. and it rose on 3 out of 5 trading sessions and rallied past the rising wedge formation. As you can see on the daily chart on your screen, last week, if you remember, I had advocated that a throw under, which means the price falling below the bottom trend line of the wedge formation, would be followed with a very high probability of a throw over. And there you see the price is above the wedge formation high, resulting in a throw over. Now, what you have to see is whether the price continues to rise or does it pull back. If it pulls back, does it take support at 46,370 levels or falls below it? As long as the 46,370 level holds, it is nothing but routine profit taking, nothing to worry about, and all is okay. Do remember the price is above its month-long moving average, which itself is headed higher. So the short-term outlook is positive for now. I now draw your attention to the RSI, which a whole lot of people are talking about on social media, that the RSI is extremely overbought at 80 plus levels. I agree. But if you read any authoritative work on the RSI, now whether it is Constance Brown or it is Walter Baines or it's Andrew, you will basically see that in a bull market, RSI can stay above 70, 75, 80 for extended periods of time. So just because the RSI is above 75 or 80 or 85, you can't take a blind pot shot and go and short the markets. Don't do that. So we'll keep monitoring the RSI. I will include it in my future charts as well. Let's stay ahead of the crowds. Friends, I revert to the weekly chart now. And as you can see, the throw over concept is now becoming clearer because the compression is now a weekly formation in size. And the price is above its 25-week moving average, which is a proxy for a 6-month long holding on cost of an average bull. So the medium term outlook is also positive. The fact that the price is far above its 25-week exponential moving average tells me that there could be possibility of a routine profit taking. And like I said, the volumes were lower. And do watch that video that I've recorded on volumes in a rising and in a falling market. The near-term support comes at 46,370, where momentum still is positive. It's only below this that short-term momentum might just ease a bit. But I'm repeating, it's only short-term momentum. It will not be a trend reversal yet. In the week before last, this index was number 2 on the highly volatile stock list based on statistical beta rankings that we maintain in-house. It maintained its position at number 2. Last week, I advocated an estimated range between 48,425 on the upside and 46,100 on the downside, which held perfectly well. In the coming week, I estimate a range between 49,325 on the upside and 47,000 on the downside. Please do refer to our free pivots on our Telegram channel. That's the only place you'll see this on any of our social media platforms. It'll help you on daily, weekly, and monthly time frames as an intraday swing or even a patient rollover trader. Whether you're futures or options or intraday cash market traders, do take help of this feature, please. Friends, the Bank Nifty done. I now come to the Nifty 50, which rallied on 4 out of 5 trading sessions and gained 2.32% in the bargain. Do note how the price was loitering around the 21,150 level for 6 consecutive trading sessions, as you can see on this chart. Once the 21,150 level was overcome, the market simply zoomed up. Now we are at 21,450 level, which is again a pattern confluence. A confluence would mean overlapping of two patterns or two price levels on the Fibonacci ruler. What we have done is taken 2 different swing measurements and plotted the Fibonacci ruler. Both these Fibonacci rulers are indicating that 21,450 odd level is very critical. So in the coming week, as long as 21,450 level is maintained as a support and the price stays above it, the intraday traders and momentum bulls are doing good. And if at all the market declines on an intra-week basis, as long as the 21,150 level, which was the earlier resistance, as long as this earlier resistance holds, even the swing traders on a weekly time compression, that means weekly option expiry or weekly expiry traders are concerned, would still be okay. We'll take a fresh look if at all the 21,150 level is violated. I will put up an update on our free Telegram channel. Now, here again, the RSI, the relative strength index, is almost 85 reading. Like I said, a whole lot of experts on the RSI, Andrew Cardwell, Walter Baines, and Constance Brown, they constantly tell you, they remind you that a reading of 80 plus does not necessarily mean immediate crash. Of course, it's overbought. Of course, it warns of a fall at a later date. But in a bull market, extremely overbought readings do tend to persist for a while. So you can't take a blind pot short sale just because the RSI is up. Turning to the weekly chart, what we are seeing is that the price is above the 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. Not only is it comfortably above, it is far above, which means a mean reversion trade might just come and trigger some routine profit taking. But the medium term outlook remains positive. Here what you're seeing is the two Fibonacci rulers, one is blue, one is red, are coinciding at 21,450 odd level in a clean kind of a chart. So we need to have the bulls pushing the Nifty above this threshold. Friends, in the week before last, this index was number 4 on the most volatile counters list based on statistical beta rankings in-house. It fell 7 notches to number 11. Not because volatility on this counter was lower, but because volatility on many individual stock counters simply shot through the moon and overshadowed the volatility on the Nifty or the Bank Nifty. Now, this is something I had warned you very clearly in my live mint column that you should brace up for extreme volatility levels. Do read that article. The hyperlink is in the pinned comment below as to why I said what I said. Last week, I estimated ranges between 21,375 on the upside and 20,550 on the downside. Admittedly, my resistance level was exceeded by 117 points because the Nifty made a high of 21,492, whereas I was estimating 21,375. But the market was in a state of euphoria after the 4 national banks refused to raise interest rates rather. In the coming week, I estimate a range between 21,900 on the upside and 21,025 on the downside. Please refer to our free Telegram channel for daily, weekly, and monthly pivot levels. It will help you as a swing and a momentum trader, intraday trader in options and futures. Friends, I now come to the last bit of statistical analysis wherein I gauge the risk appetite in the retail segment by way of turnover contributed in the 4 derivative segments and on the weekly chart on your screen. What I am seeing is index futures turnover contribution was flat, which is indicated as a blue line. Where stock futures turnover is concerned, it went up by 2 basis points and it is indicated as a red line. Now, futures demand the highest amount of capital from traders, and index futures are less volatile compared to stock futures. So, the fact that stock futures saw higher turnover means traders are willing to take a higher risk approach in the market. In the relatively lower capital requirement option segment, the index option saw a 30 basis point decline in turnover contribution. Now, this is less volatile compared to stock options, and stock options also demand a higher bit of span margin where option writers are concerned, and option premia for option buyers. So, trading stock options is a little more capital intensive compared to index options. And here, the traders were concentrating on higher risk stock options where it requires higher amount of capital. So, risk appetite, I would say, was definitely higher. And do remember, MWPL is at a multi-month high. So, the swing traders in futures were also showing higher risk appetite. So I'm not worried about the risk appetite being inadequate in the market because of which the market can fall. No, I'm not worried about the absence of risk appetite. I'm only talking about a routine profit taking. And that routine profit taking can also appear to be vicious. I'm using the word appear because the rally has been spectacular. So a decline has to be in percentage terms, not just according to the levels that an individual trader feels comfortable. The market will go by its statistical metrics, not by our expectations. Friends, I now come to a segment where I share my personal trading strategy for the week ahead. And for many months now, I have been telling you that I would favor PSUs and in the PSU space, the PSBs, which is public sector undertaking, and PSBs, public sector banks. And as a matter of fact, last year I have recorded a special video on why I like trading public sector unit stocks as a trader. And there are statistical, psychological, and extremely down to earth, simple points as to why you should focus on PSUs. Please watch that video. You will have a greater understanding of what I am saying. Now, as long as there's a winning formula, why change it? So, as long as PSUs and PSBs are giving you alpha, which is pure trading profits, why look elsewhere? Do focus on this segment in either direction. Now, I had alerted my online family about the possibility of a pullback rally in oil and gas. I had said that the concerted efforts by Saudi Arabia and Russia, especially Putin's visit to the Kingdom of Saudi Arabia and the United Arab Emirates, would result possibly in a spike in oil. Along the same lines, as the Saudi king's visit to Russia in October of 2017. So, although the magnitude of the rise may not be as much as the 2017 oil price hike, at that point in time, oil prices jumped 50% and they fell only after Jamal Khashoggi's murder in October 2018. But this time around, you are unlikely to see a 50% jump in oil, but you could see a little bit of a bump up for sure. So, if you are a theta decay trader, do not rush in, as I advocated even last week. Wait for some more price rise before you ride deeply out of money call options. The long term story, of course, remains bearish. I'm still not supporting a super cycle theory in commodities, especially energy. So I'm, like I said, I want the price to go up because I don't have any short positions in crude oil or natural gas at this point in time, and I am waiting to jump in at the appropriate price. Bullion is likely to remain volatile as long as the US dollar index, the Dixie, and the USD INR are weak. MCX gold and silver will see dips, if any, getting bought into. And metal prices, I'm talking of industrial metals now, are witnessing a short covering rally. At this point in time, I'm not saying it's a bull market. I'm saying it's a short covering rally. Let the data points emerge saying it's a bull market, then I might change my view. But at this point in time, there's a short covering rally in metals on commodity exchanges. So stock markets might see metal stocks move up in tandem based on the underlying metal prices. So friends, in sum and substance, this is my trading strategy for the week ahead. Do let me know what you think of this video, how my videos help you become a better trader, and do share my videos with your family and friends in social media groups so as to help me reach out to a wider audience. Before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here, and Do share my video with your friends, as I said. I thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Do have a very, very profitable week ahead. Take care. Bye bye.